Okay, let's take a look at this basic CV analysis problem. I recognize that the screen you're looking at may be a little bit hard to read, so let me read that for you. Mystery Company operates a chain of watch shops around the country. The shops carry many styles of watches that are all sold at the same price. Sales personnel in the shops are paid a substantial commission on each watch sold, in addition to a small basic salary, in order to encourage them to be aggressive in their sales efforts. Okay, then we have an Excel diagram of the cost and revenue data for Shop 30, and this one is typical of the company's many outlets. Now, let's tackle the first requirement, which says calculate the annual break-even point in dollars in sales and units for Shop 30. All right, well, hopefully you see to the left we've got a selling price of $40, variable expenses that total $24, and then fixed expenses that equal $150,000. So let's switch to another graph and see if we can put that together. Okay, we know we need to come up with sales less variable costs, right? Which would come up with contribution margin. And then we could subtract fixed costs, and then that would equal net income. So if we're trying to solve for break even, we know that the net income has to be equal to 0. Or we could invert this formula, right? And we can work it backwards, fill in what we know, what we don't know. Or we can use the break-even solution, which says break-even is equal to the fixed expenses divided by the unit contribution margin. Okay, well, what do we know? We know that the selling price is $40, the variable costs are $24. So if we do it on a per unit basis, we know for 1 unit, selling price is $40, variable costs are $24. Therefore, the contribution margin per unit must be $16. So if fixed costs are $16 per unit, we would arrive at a break-even equal to 0, right? Now that we know that on a per unit basis, we're able to compute the unit contribution margin is $16. So we can then say, well, fixed costs are equal to $150,000 to the left of my mouse, and we can work with it that way. $150,000 divided by the $16 per watch cost, and we come up with break-even of $9,375, and that's in units. So I'm going to just type in the word watches or units. Okay, that's how I would solve Part A. Okay, and I'll just format it that way so you can sort of see how we derive the net income. Put a double underline under that, which is 0 at the break-even amount. Okay, now we take a look at number 2. It says prepare a CVP graph showing cost and revenue data for Shop 30 from a 0 level of activity going up to 20,000 watches. Alright, well, rather than draw that by hand, I'm going to just slide over what that graph would look like. I'll slide down a little bit here. It would look something like this. Let me slide this here. We would see the total sales revenue going up as a straight line because for every watch we sell, we get the same dollar amount for it. Our fixed costs are a straight line at some level, and then the variable cost increase and go increasing as we sell more. So total costs then follow this line right here. We start at the fixed cost and we add the variable to it. And the break-even point is right there. 9,375 watches, or it's 375,000 in total sales. Okay? And if we wanted to prove that, we could certainly drop in the numbers and do that. Now let's look at number 3. 3 says if 9,200 watches are sold in a year, what would be Shop 30's net operating income or loss? Okay, so now we had sales of, I'm just going to work number 3 off to the side right here. We're going to have sales of, okay, let me work part 3 actually right over here. We're going to have sales of 9,375 watches, right? Isn't that what they're saying? 9,200 watches, my mistake. So we say equal 9,200 watches times $40 per watch. And we come up with 368,000 sales. Variable cost would equal 24 times 9,200 watches, right? So we'd have 220,000, and then from here we can just subtract the contribution margin. Just copied from cell B4. We can come up with 147,000. We already know that the fixed costs are equal to 150,000. Now, we have that from the left of the mouse right there. So if we sell 9,200 watches, this is 150,000, what we come up with is a net loss of 2,800 units. $2,800, excuse me. That takes care of requirement 3. Now, requirement 4 says the company is considering paying the store manager an incentive commission of $1 per watch in addition to the salesperson's commissions. If this change is made, what will the new break-even point in dollar sales? What will it be in dollar sales and dollar units? Okay, so now I'm going to work that next one just right over here. And the only difference we have here is, or actually we could do it here, the difference is that we've got an extra $1 of variable costs. So on a per unit basis, at least down to contribution margin, if we put it right here, we can say the variable costs go to $25. The contribution is now $15 per unit. So now to do the new break even, I'll put the same thing right below me here. And this will be number 4. Actually, why don't I label this so we can tell that this is number 4. We now have fixed cost of 150,000. Instead of dividing it by B5, by the way, that one, it actually was from B4, but when I copied it down, it goes to B5. Now we're going to divide it by what's in cell C4, right? That $15. And so the break-even goes to 10,000 watches. Okay? And if we then wanted to turn that into what was the sales dollars, you could take the break-even divided by the unit contribution ratio or margin percentage. And the margin percentage, let me just jot it right here, would be equal to that 15 divided by 40, which becomes 38%. Maybe if I move over, it's 37.5. So we would take the fixed cost equal to 150,000 divided by that new fixed cost contribution unit contribution margin ratio or unit contribution ratio, and you now come up with 400 in sales. Okay, so that answers it both in terms of watches and in dollars of sales. That actually is in dollars, so I'll label it that way. Okay. 5 says, refer to the original data as an alternative to 4 above. The company is considering paying the store manager a $2 commission on each watch sold in excess of break-even point. If this change is made, what will the shop's net operating or income loss be if 11,600 watches are sold? All right, let's tackle that one next. Okay, I'm going to put number 5 under this column here, and I know I'm not doing a good job of labeling these, but well, maybe we could insert, and let me get rid of the color here. We'll call this one number 5. So we'll okay, and that obviously doesn't need to be that large, but number 5, if we work that underneath here, the difference now is we're going to have sales of, what was it, 11,600 watches, I believe? Yeah, 11,600 to the left of my mouse there. So we have 11,600 times $40 per watch. The variable costs now are back to the original amount of 24 watches. I think they're telling us we're selling 11,600 watches are being sold, and we've got to get over the break-even point. And we already determined that the original break-even was 9,375 watches. Okay, so we've got 9,375 watches times the original variable cost of $24, and then we've got an additional 2,225 watches, 2,225 times $26 because of that $2 additional store manager bonus. So that times, I'll make it 26 so you can see what I'm typing in here. Okay, it's asking me, is this what you wanted? And that is what I want. So that becomes 282,850. We then can subtract, just copy from the previous case. So now we have contribution margin of 181,150 less our fixed cost, and we would have a net operating of 31,150. That takes care of number 5. Number 6 says, again refer to the original data. Now the company is considering eliminating sales commissions entirely and increasing fixed salaries by $45,000 annually. If this change is made, what will be the new break-even point for Shop 30? Let's take a look at this one now. Okay, this time let's copy this here. We'll call this number 6. And we'll just delete here and start putting it in as we go. Alright, so what's different here is the new expense goes down to some different cost patterns. They want to know break even first, so why don't we tackle that here? I'm going to copy from here and label this as number 6. And the break even we have now is fixed expenses divided by unit contribution margin. But the fixed expenses aren't going to be equal to 150,000. This time the fixed expenses are the 150 plus an additional 45,000 of fixed salaries. So we have the 150,000 given in the original case plus 45,000, right? And let me put parentheses around that, parentheses. And then we've got to divide it by the new unit contribution margin. Right now, the new unit contribution margin we have to calculate. I think what I want to do is create a new column. Just insert this here. Shrink this a little bit, and I think we'll still have plenty of room. All right, let's copy down to unit contribution margin here. This also is part of number 6, so I'll label that there. And what we know is we still are going to sell them for $40, but now our variable cost goes to $14. Now, why does it go to $14? Because the sales commission is gone. So instead of 24, we only have the invoice cost of $14. So that becomes 14, leaving us a unit contribution of $26. So now we can step into this formula and divide it by that $26, coming up with 7,500 is our watches in units of break even. Alright, so once we have that, we've answered the question. If this change is made, what will be the new break-even points in dollar sales and in units? Alright, well, we've done units first, so now let's do it in dollar sales. And again, I'll just copy from here. I'll label this as number 6. And the difference now is we need to take from the 150,000 plus the additional 45,000 of fixed salaries, right? and we're going to divide it by the unit contribution margin. Well, to do that, I'm going to put it in that cell, which right now will give us an error. But as soon as I copy this to here, we see that it becomes 65% and our error corrects itself. And the new sales structure is $300,000 break-even sales. Okay, and that takes care of number 6. So I guess we really didn't even need a column over here. But there is some other questions. It says, would you recommend that the change be made? Okay, so with the data in front of us, now I recognize I didn't organize it very well, but we did work through all areas of this problem. It's asked, would you recommend this? And I think the point we should make is that although the change in number 6 will lower the break-even from 9,375 down to 7,500 watches, the company needs to consider whether the reduction in break-even is more than offset by any possible loss in sales. In other words, the sales staff may have much less of an incentive to sell when they're not earning a commission than if they were earning a commission. Normally, you would like a low break-even point, but that really isn't the objective. The objective of the management is to maximize the profits of the owners, right? And we should be concerned with net income, which is much more important than break-even, right? To maximize the wealth of the owners, we want to maximize the net income. So break-even point is certainly important, but we need to balance it with the primary goal of a firm, which is to increase the wealth of the firm's owners. So the break-even point can be reduced by doubling selling price as well, but that may not necessarily result in what is best for the owners, because doubling price may have a drastic effect on the volume of sales we would make. And that takes care of this problem, everyone. Thank you.